welcome to another edition of Trust Issues by Kepler Trust Intelligence. In this podcast, we speak to leading investment trust managers about the philosophy behind their strategies and the themes shaping their portfolios. In today's episode, we're joined by Randall Sandstrom, Chief Executive and CIO of Sequoia Investment Management, to talk about the Sequoia Economic Infrastructure Income Fund and the opportunities for investors in the infrastructure debt sector. So Randy, many thanks for joining us today.
Thank you. Pleasure to be here.
Great. So could you start by giving us a sense of what SEQI offers for investors and also how active management adds value in this space?
Yes, absolutely. Well, maybe first we can say, what is SEQI? Now, SEQI is the ticker symbol for the Sequoia Economic Infrastructure Income Fund, which trades on the London Stock Exchange. SEQI has a 10-year track record, and the company that I'm with, Simco, is the investment advisor to SEQI. And what SEQI does is it's slightly different than other listed infrastructure funds. Those other funds are what's called equity funds, and those funds actually own the projects, whereas we're sort of like a bank. We make loans to infrastructure projects. So just right off the bat, a loan is considered a safer place to be because you're higher up in the capital structure than actually owning the project and being subject to the volatility of that sort of investment. And specifically what SEQI does is that we make high yield loans to mid-market infrastructure projects globally in developed markets. And by high yield, we mean a couple of things. One is exactly that. It's a high yield. Right now, the yield on the portfolio is about 9.3%. But high yield also means something else. It talks about what part of the market, of the lending market, are we involved in. And for those of you out there who are familiar with the credit ratings, anything that's BBB and above is considered investment grade. That's a low yield part of the market. That's not where we are. Anything BB and below is considered high yield, and that's where we participate. And specifically, to answer the question, what does SEQI offer? SEQI offers investors easy access to this really important asset class, which is otherwise fairly difficult to get. Normally, the way that an investor would get access to infrastructure debt is either A, making the loan themselves, which obviously is not practical for most investors to do. That's why they come to us, or investing in what's called a private fund. Now, some people refer to that as an LPGP fund, limited partner, which is the investor, and general partner, which is the manager. Now, that's a great place to be for lots of investors. However, private funds are usually sort of limited to the institutional market because they usually take a large amount of investment. And the other important point is that when you invest into a private fund, you get what's called an LP interest, a limited partner interest. And that's a very illiquid investment. So you don't have the benefit of liquidity. You also don't have the benefit of governance like a listed fund does. The board, of course, for a listed fund looks after the interests of shareholders. And also with a listed fund, you have the marks on the loans, which are done independently, in our case by PwC. The second part of your question about the benefits of active management. Well, first, let's say what we're talking about. Active management is, of course, where an investor wants to go out and hire an investment advisor or an investment manager such as Simco, rather than invest into an index to get exposure to an asset class. So what are the benefits? Well, the first benefit is the potential for outperformance. And what we mean by outperformance, let's define that first. That would be where the manager can earn a return in excess of the return that would be expected for a given level of risk. Now, what folks call that is alpha. Some of your investors may have heard of alpha before. Now, achieving that is most possible in an inefficient market. And what we mean by an inefficient market, this is where prices for loans or bonds, in our case, don't necessarily reflect all of the current information at that time. And that's what infrastructure debt is. The hallmarks of an inefficient market are an illiquid market, and we're investing in private loans. It is illiquid. And also a market where you don't have a lot of competition. We don't have thousands of managers in infrastructure debt poring over all the opportunities like you do in corporate bonds or listed equities, for example. A second benefit would be flexibility and judgment. And what I'm referring to here is, in a time of a market dislocation or an economic shift, you want to be able to take advantage of opportunities that come up. COVID is a perfect example. Now what you wanted to do was to avoid sectors that were being most affected by COVID. And given that, business came to a standstill, one obvious example there is transportation. And then the third main advantage of active management would be opportunistic investing. When we started SEQI, it was right after the sovereign debt crisis, which was right after the great financial crisis. And banks were in the mode of unloading assets at that time, lightening up their balance sheet. So we were able to step in and buy some good secondary loans at good prices and take advantage of that. But it's important, it doesn't need to be either or. Investors can certainly employ a passive strategy as a core strategy, and they can also use an active strategy as a sort of satellite strategy where the skill of the investment manager can add value.
And building on that, could you provide a brief overview of how the trust has performed recently?
Yes, thanks for that question, Joe. Sure. Well, overview of recent performance. Now, this is going to involve some numbers. There's no way to talk about performance without mentioning some numbers. So over the life of SEQI, the performance has been really good. And in general, it's been good. The NAV total return, which is the return from both income as well as capital appreciation, has averaged 8.4% per annum. Now, to put that in perspective, the average total return for high yield corporate bonds, which have been swapped to sterling to remove any currency effect, has been 4.3%. So we've been able to outperform corporates by 4.1%. Now, if we narrow that down more and we look at the last 2 years only, not the last nearly 11 years, our total return has been 8% per annum versus high yield bonds at 7.5%. Now, our outperformance there is a little bit lower. And the main reason for that is that we were still working out a few non-performing loans coming out of COVID. If we shorten that time frame up even more, and we look at, for example, the last 6 months, we've really done well. And we've had just great performance by both the asset and the PM teams at SIMCO. Our annualized total return on NAV for the last 6 months has been 11.9% versus high yield bonds, of which has been 7.4%. So that's outperformance by quite a bit, over 4%. And a lot of that is because we had worked out almost all of our NPL, our non-performing loan exposure by then. Another measure of performance would be the discount. We've been able to hold that discount to NAV at a pretty steady level, and also at the narrow end of the range of discounts. Our current discount right now is between 14 and 15%. If you compare that to the average infrastructure equity fund, the range is 11 to 26%. Now, the 11%, that's one fund. It's a bit of an outlier. But SEQI's in good stead. We're right in there at 15% with 3i, IPP, and SEQI. All three of us are at 15%. So we're not happy with that discount, but we are managing it carefully, and we're at the tighter end of that range. Now, another important measure of performance would be NPLs, non-performing loans. Now, I mentioned that earlier. We've been able to bring those right down by resolving those. So our non-performing loans right now, and this is an important measure of performance, are only 60 basis points, 0.6% of NAV, and that's down from about 5% a little over a year ago. Now, to put that number in perspective, if you look at the sort of normal range for non-performing loans in a high-yield credit portfolio, it's about 0.5% to 2%, and most investment managers want to keep that number down to 1% or less. So we're at 0.6%, so we're really happy with that. And that 0.5% to 2% range that's typical, that's in a normal market. In periods of stress, that number can be upwards to 2 to 5%. So at 0.6%, we're quite happy with that level of NPLs. The portfolio is in very good shape.
Thanks for that. So data centers are currently a hot topic for investors, but it seems that you've actually been reducing your exposure. So could you talk us through the reasoning behind this decision?
Yeah, absolutely. Well, we were a very early mover in data centers. We did our first data center loan back in circa 2016, 2017. And, it's an important sector for the economy. It's obviously very important for the digitalization sector as a whole. But what you've seen since we've done our first data center loans, and particularly in the last couple of years, is just a lot more capital, both debt capital and equity capital, coming into the sector. And what that has resulted in is tighter spreads, less return per unit of risk. Alongside that, you're also seeing deals in some cases which have thinner equity cushions, i.e. higher leverage, less protective covenants, perhaps less of a track record by management, maybe less experience by the sponsor themselves. These are hallmarks of sectors that are getting, more active by other folks, other investment managers. So we're backing off a little bit. We still like the sector. The other reason we're backing off is that we're essentially full. Data centers form part of what we call digitalization for one of our major sectors. And within that sector, we have data centers as well as telecom towers and select broadband exposure as well. So we're really full. So what we're doing right now is we are seeing some opportunities that we like selectively, but we're doing what's called a one in, one out. We'll only put on additional data center exposure if we can see pretty clearly that an existing position is going to prepay or refinance.
And when you're looking at new opportunities, what are the types of green flags that catch your eye? And do areas like energy and renewables perhaps fit that bill?
Yeah, they absolutely do. When we look at a new position, the first thing we need to ask ourselves is, is this eligible? Does it fit our definition of economic infrastructure debt? And broadly speaking, assets that are in the three really broad sectors of energy transition and digitalization, and energy and renewables would fall into energy transition, and transportation, thirdly. Opportunities need to fall in those three very broad sectors in order for us to get involved. If it fits, then we're going to look at things like risk return. That's really important. And as part of that, we're going to look at things like how essential is the service to the economy? Is the technology that they used established and proven? Are cash flows predictable because revenues are contracted? That's another important feature that we want. And also, how much pricing power does the company or the project have for its product or service? Or is it in really a very competitive sector? Those are sort of project-specific green flags that we look for. Then we're going to move into management, team, and sponsor specifics. And here what we want basically is experience. So we want a management team of the company or the project that has experience managing a capital-intensive business. We want to look at how the management team is incentivized. First of all, are they incentivized? We want that. But we want the right incentivization package. And that could, sometimes it's based on revenues. That's not quite as good as being based on profitability. So we're going to look at things like that. And then also we're going to look at how does the team manage the risks that they're exposed to, not just financial risk, i.e. leverage and business risk, but also operational type risks. For example, if it's a power station, do they hedge their power price exposure? And do they have experience in managing that exposure? So really, if you sort of wrap all those things into one, when we go into a project, the sort of green flags that we want really boil down to experience, an acceptable amount of leverage, i.e. a nice big equity check, and also a sponsor with deep pockets.
So stepping back a bit and looking at portfolio construction, what's the sensitivity of your portfolio to interest rates? And are you comfortable with the current split between fixed and floating loans?
Yeah, we are comfortable with that split right now, which is about 60% fixed and 40% floating. And to talk about interest rate sensitivity, our portfolio is pretty unsensitive to interest rates. Now, the way that people measure that sensitivity, I don't want to get too technical, but it's something called modified duration. And that's just a number. For us right now, it's 2.2. And what that means is that if you have a change in interest rates of 1%, you're going to have an opposite change in the NAV of the portfolio of 2.2%. That's what would be expected. Now that change, if it's a negative change because rates have gone up, is just a mark. It's just a mark. It's not a realized loss. And if that happens, absent a credit event, that loan or that bond will mature at 100 cents on the dollar. So that measure, that modified duration of 2.2 is pretty low. If you look at a typical high yield corporate bond portfolio, there you would have a modified duration of about 3 to 4. Now, the reason that our modified duration is pretty low, our interest rate sensitivity is pretty low, one of the largest reasons is exactly what you asked about, Joe. It's the split that we have. We have a significant amount of exposure in floating rate, and that dampens down the sensitivity to changes in interest rates. So that's really important. And really, the way that we manage our interest rate sensitivity, i.e. that modified duration, is basically 3 ways. One is the amount of floating rate exposure that we have. Also, on the fixed rate exposure that we have, not going out too long. We don't make 20 or 30-year loans. Insurance companies do that. They need long-dated loans to manage their exposure on the liability side. We don't do that. We're looking more for income and total return. So our loans are shorter. They tend to be, for example, 3 to 7 years in general. And then thirdly, we will, around the edges, do interest rate swaps as well to manage that interest rate sensitivity, that portfolio modified duration. So all in all, our sensitivity to interest rate changes is pretty low.
Thanks. And do you take on any construction risk as part of your approach, or is that something that you generally avoid?
Well, we do take construction risk, but we're extremely selective. Our construction exposure is capped, according to the prospectus, at 20%. Right now, it's in low double digits, about 12 or 13%. And the reason for that is that all the research shows, and our experience shows, that construction is the riskiest time in an infrastructure project's life. So we don't want too much exposure there. The other thing that happens is that lots of times, not all the time, but lots of times, banks will bid too strongly for a construction loan because they might want some other business from that borrower. They might want to do their next IPO. They might want to do different facilities. We don't want to compete against a bank who might be bidding on a piece of business for non-economic reasons. So sometimes we stay out of construction exposure for that exact reason, but not all the time. Sometimes we see construction exposure that we like, and the hallmarks there would be A, we get paid for it, we get a high return, and B, it's low risk construction. An example there would be easy construction. A solar project is a perfect example where you're really doing more installation. However, you still have that construction label, so you tend to get a pickup. And so those are opportunities that we'll look at. We'll also look at construction that's very short. For example, a couple of years ago, we did a neat deal, which was a floating liquefied natural gas ship. Now that's more complicated construction. However, that construction was nearly complete. It was about 95% complete when we came in, and that was exposure that we felt comfortable with credit-wise and that we got paid for.
Great. And one final question, if we may. Looking ahead, where are you finding the most attractive opportunities in the market right now?
Yeah, absolutely. Well, going back to our broad sectors, I would say that energy and digital are 2 great areas. As I said, on digital, we're doing one in, one out on data centers, but we do see other opportunities, for example, in telecom towers and very select broadband. But energy is a really important area right now. So that's another area where we're seeing opportunities. And these opportunities really are right across the spectrum. They could be the refinancing of a construction loan. They could be, in very special circumstances, a construction loan. We've talked about that, but it's only if it's a deal that we feel is right. Or it could be more of a structured solution, an equity bridge loan, which is a short-term loan bridging to an event. The example there would be an infrastructure equity fund, which is raising capital and and they need money to do some corporate event, but they haven't quite finished the capital raise yet, but they're almost there, and we can make them a loan to bridge that. Another example of an equity bridge loan would be an infrastructure project that's selling an asset, for example, and they're almost done on the asset sale, but it's not quite done, but we can see that it's very close to being done, and we can bridge that with a very short-term loan. These loans are good for the fund in the sense that these borrowers need that money to finalize that corporate event, and they're willing to pay up, and we can earn a good return for our shareholders.
Fantastic. That seems a perfect note on which to finish. So many thanks for joining us today.
Thank you very much, Joe. It's always a pleasure to come here to speak to you and your investors, and I'm happy to do this again.
Thank you. You can visit SEQI's website to find out more information about the trust, and you'll find our latest research note on the Kepler Trust Intelligence website. And we hope you join us again soon for another edition of Trust Issues. Past performance is not a reliable indicator of future results. The value of investments can fall as well as rise, and you may get back less than you invested when you decide to sell your investments. It is strongly recommended that if you are a private investor, independent financial advice should be taken before making any investment or financial decision. Please be aware that there can be a time lag when we release podcasts, meaning time-sensitive information may no longer be accurate at the time of publication. Kepler Partners LLP has a relationship with some of the companies covered in this podcast, which may impair its objectivity. Kepler Partners LLP is authorised and regulated by the Financial Conduct Authority.